So the market breadth is widening. There is no doubt about that. And in front of you now is the Mag 7, the Magnificent Seven. And some people lately have been actually taking Tesla off that list because Tesla has struggled recently. So now some people are calling it, the Magnificent Six, perhaps, or the Mag 6. But overall, these are the names that have powered the stock market for the last, well, just over a year. But the good news is we're starting to get other sectors joining in on the party. And I wrote down some data. And again, I don't want to get the data or get the numbers wrong. More than 2/3 of the S&P 500 have a positive return year to date. 2/3 of the S&P 500. About 177 companies are beating the S&P 500 on a year-to-date return basis. About half, or just under half, about 233 companies are up over 5% year-to-date. They've seen their stock rise above 5% year-to-date. And probably the more important stat is this. The Mag 7 last year made up over 70% of the gains on the S&P 500. This year, yes, they're still making up a big amount of the gains, but only about 57% of the gains. So we're starting to see more sectors joining in on the growth on the S&P 500 and on the growth of the stock markets in North America in general. And this is really, really important. First chart we have to show you, it's actually a chart of two charts right beside each other. You're going to see here on the left side, we have the S&P 500 equal weight index. So that's taking everything on an equal weight basis. And the S&P 500 just regular on the right-hand side. And you can see how well the equal weight index has done. It hasn't underperformed the regular S&P 500, whereas last year, you would have seen the S&P 500 outperform the equal weight index, which tells me that the S&P 500 is being dominated by the largest companies, and it has been for the last year and a half, but not as much anymore. And coming into this year, if you recall, on our previous shows, I said the Mag 7 those companies would have a good year, but wouldn't be as dominating because other sectors would join in on the fun, and that's exactly what has happened. And we have a bunch of stocks we're going to go through here, their charts. First one, Caterpillar, which we saw already. But again, an industrial name, another sector that stock in another sector doing extremely, extremely well. Name we don't really talk about an awful lot. This is in the travel space, Marriott International, hotel chain, right? How well are hotels doing? Well, let's take a look. We have a chart on Marriott International. We can put that one up now. There it is, doing extremely well. If you didn't look at the name, you would think this was a tech stock. It's not much different than the charts I would show you from tech stocks. Marriott International, what a run that stock has been on. A name I've spoken about many times on the show, Target. A lot of people have been shying away from the name. Look how well Target has done. It's come down a little bit on the far right-hand side, but it had a pretty good run, almost a straight up line over the last, let's call it, few months. Target doing extremely well, obviously in the retail space. Eli Lilly, I mentioned it earlier, one of the biggest companies in the world. In the pharmaceutical space, we have a chart on Eli Lilly, and this stock has done extremely well, obviously with its diabetes drug, and now it's weight loss drug. It's doing extremely well. Alzheimer's as well. It's doing a lot of great work in many different areas. And again, a pharma name, so not just tech, but now also pharma doing extremely well. And last but not least, let's look at a bank stock, and the largest bank stock in North America, JP Morgan. How well has JP Morgan done? Extremely well. Had you owned the biggest bank stock in the US, you'd be doing just fine. JP Morgan at all-time highs right now, trading here showing about $194 a share. It's been an unbelievable run for the biggest bank stock in the United States. So market breadth has definitely expanded. We've seen a lot of companies sharing in good times, the profits. We've seen a number of good quality companies trading higher and yet still good value. And I think as an investor today, this is something we all love because it gives us opportunity to build nice, diversified portfolios, putting money into different sectors of the market depending on obviously a person's investment objectives and risk tolerance and all that. But it allows us to build these really nice, big, diverse portfolios because more sectors are joining in on the fund.